What we're seeing in terms of cycle right now in Spain is very typical of what we experience through the ages and cycles. We're coming from the phase when we saw big private equity funds buying on a more opportunistic basis, buying non-performing loan portfolios and big high volumes. And now we're entering a phase where we're more discussing asset-based, value-added investments, meaning smaller investors looking on an asset basis, also trying to cherry-pick the bigger portfolios that were transacted in the last 2 years and trying to create the value and add the value in order to actually then bring them back to the core market and so spin them off in the next 1 or 2 years. And that obviously means there's more real estate fundamentals probably being applied now than there used to be when it was more financially driven transaction. That means we are seeing probably discussions on a more real estate professional level. We're seeing a lot of business also for real estate technical companies. We're seeing the fundamentals being managed. The investors obviously are smaller ones, and we're seeing quite a few family offices. At Valid, we're seeing interest, and we're having a lot of discussions recently with national, local Spanish, as well as German and international family offices. Private wealth is moving in, and obviously with a different risk profile, those who are willing to assume some risk and who feel capable through the hands of some local advisors to actually manage those risks are coming in. They're accepting yields which core investors would probably find very, very demanding, because even value-added schemes, if you're buying them on a reversionary rental basis, you're buying sub 5% when you're buying offices in the center of Madrid or Barcelona for that matter, which is sharp yields, but obviously highly reversionary because you need to do a refurbishment, but then you can let on a much higher level. There's usually high vacancy, so you've got some letting up potential, which would eventually, in our experience and from the calculations we're doing on these projects, give you a very solid IRRs of 10–11%, which is good for a private investor. Probably not good enough for an NPL opportunistic investor who is looking for 15–20%.